Okay, please start. Namaskar. On behalf of Council for International Economic Understanding, CIEU, myself, Raman Agarwal, Area Chair NBFCs at CIEU, welcome you to this second episode of our talk show on the growth capital. Friends, you may recall that we started this talk show just before the second wave struck, that was in the month of March. And we had done the first episode in the NBFC series with Mr. T.T. Srinivas Raghavan, Managing Director of Sundaram Finance. And we had talked about the four important pillars of NBFCs. We talked about N, norms, that is regulation. We talked about background, that is history. B, F as in the future or the road ahead. And C, that is the challenges. So we talked about the NBFC of the NBFC sector in that episode. I'm pleased to share that today we are joined for the second episode by Mr. Umesh Revankar, who is the Managing Director and CEO of Shriram Transport Finance Company Limited, which I'm sure everybody knows is perhaps one of the oldest and undoubtedly one of the leading NBFCs in India today. Welcome, Umesh, and thank you for sparing time. Let me also mention that Umesh is also the co-chairman of Finance Industry Development Council, FIDC, which is the industry body for NBFC sector. So friends, today we are going to again talk about a different set of NBFC of the NBFCs. So today we are going to talk about N as in negating the negativity, because we often see a lot of negativity being spread about the NBFC. So how do we counter that? B as in the business model, because we need to understand NBFCs have got some very interesting and unique business models. F as in the failures and what have they taught us. We've seen some failures in the sector and what learnings they bring to on the table. C as in the collaboration, because we feel that going ahead, collaboration is going to be the mantra. So today, again, a different set of NBFC of the NBFCs. So I'll start with the N, that is the negating the negativity. So Umesh, we've seen that, often that in spite of all the good work that the NBFC sector has been doing over, I think, almost a century now, if I may be correct, and we have some old NBFCs, including Shriram Transport Finance. There often people talk about a lot of negative stuff about NBFC, especially we see negativity flowing in at the level of policymakers also at times. So what do you think is the reason for this negativity?
Thank you, Raman. Thank you for having me in your session. We have been working in NBFC industry for quite a long time, both me and you, and our company is more than 4 decades old. See, the non-bank is, I don't say there is a negativity here. What I feel is that the way the business in India flourished over the period has been a little differently from any other place in the world. The kind of entrepreneurship Indians have, that created an opportunity for people to get associated with the lending activity. And if you go across the country, there are many communities. It's community-based or the local need-based financing arrangements have been done. In India, there were not many strong institutions or not many strong banks and not many large lenders to start with. Maybe I'm talking about around 100 years of modern India. I'm not talking about the past. And thereby the society, they carved some kind of a specialization into financing. Thereby the finance companies came. And Indian constitution or Indian the business environment allowed people to build their own businesses, whether it is money lending or whether it is financing, whether it is registered companies, partnership, many companies emerged. And in the beginning, a lot of non-banking finance company came because there was an opportunity for a company to be formed. And you could raise deposit once you register as a non-bank finance company. So the non-bank finance company came, raised public deposit. They were not dependent on bank for raising resources. Most of the companies flourished based on their ability to raise resources with the capital investment and by public deposit. So there was not much of bank and non-bank relation to start with. Then over the period, as non-bank finance companies become large and big, they started raising some debt from the banks also, and thereby non-bank finance companies flourished.
Right.
Now
please.
Yeah.
Please go ahead. Please go ahead.
Now the negativity part has come only because of the international experience.
Okay.
Internationally, I feel there are not many good examples of finance companies getting flourished. Therefore, the too much of our learning or depending on international financial structure, we started developing that there is something negativity about non-bank finance companies. That's how I feel. Otherwise, the Indians by nature.
I think you've touched upon an important point, and this is very critical. So I think what you are saying is that NBFCs, the way they work and function and the way they originated, is a typical model to the Indian ethos, which perhaps we may not find parallels in the West and the developed economies. And that's why drawing example from the West and trying to institutionalize everything was where this negativity started creeping in. Correct?
I agree with you. That's how what I meant here.
Good. I think so. That's a very good learning from us. So now, since you are also the co-chairman and FIDC, and we all know FIDC was something we all very passionately work about. So at times we've seen even RBI talk about it, and often people talk about that. Perhaps if we can set up an SRO in the NBFC sector, that may help in countering such negativities. Do you agree with this? Do you think FIDC should play the role of SRO?
Definitely, yes. See, SRO gives a positive connotation about non-bank finance company, but that is not a necessity. So what I feel is FIDC can definitely play a role voluntarily as SRO, but the size and different style of functioning, various niche players we have, the kind of varieties we have, it becomes a difficult task for SRO to represent. Now, maybe I draw parallel to in Indonesia. In Indonesia, also a lot of finance companies are there, and there is a separate ministry there to look after the finance industry, which is treated as if it is a very important industry, and therefore that kind of importance is given. But in India, the kind of variety of non-bank finance companies are so large, it becomes a difficult task for having a SRO. But there can be a broad understanding, and there can be a broad what you call guidelines given by the SRO, not necessarily binding, because you can't be putting any binding. Then we are restricting ourselves. So if you are only vehicle finance company, you are right. But we are just not vehicle finance companies. We have so many other varieties.
Absolutely. Right. And there's another very important element, and we often, we've seen within the industry and outside also people talk about, this whole talk about the negative connotation of calling us as a non-bank something. And added to it is the term of shadow banks, which I don't know, which suddenly crept in the early 2000, perhaps in the first decade of 2000, this current century. Do you think both these negative connotations have also kind of played a role in this kind of negativity creeping in?
See, let me first touch upon shadow banking. Now, the word shadow bank has come in one of the what you call explanation given for the institutions which are not licensed as banking. So
Right.
all the other companies which are not into banking are called shadow banking because they indirectly do some kind of a banking activity, not exactly banking activity. Therefore, it was loosely used. But if you try to use it positively, uh, there is something called shadow cabinet in UK. That means the opposition team works as a shadow, so that when the cabinet is functioning, a shadow cabinet also functions, just to fill the gap where the actual cabinet is not functioning. So if you draw positive in that, there is a lot of you can put a lot of positiveness in shadow by saying where bank is not able to reach, where bank is able to or not able to do the function of financial services provider. This shadow banking is reaching to that particular aspect, so that the customers by and large get all aspect of financial service.
No, I think that's
Because
very interesting. So what you're
that's
hinting
what,
at is
yeah,
that let's not get this thing by the word shadow, because shadow not necessarily means shady. It could
yes,
even mean that you are in the shadow of a particular activity. So as you said, like you have a shadow cabinet, you can have a shadow lender which reaches out where the bank or which is the prime lender is not reaching. Very
yeah.
interesting. I think it's a very
That's
different,
the,
and I'm hearing it for the first time. Thank you for
then
that
I'm
bringing.
going to the non part of it,
Yeah,
Raman. So what I feel is maybe if RBI redefines it as a para banking, it can become much more positive word, because ultimately we do almost every activity like a bank, lending, collecting, everything. Some of them are even deposit taking, but not exactly giving a day-to-day requirement of
yeah,
savings account or current account. Other than that, we do certain portion of a banking. So you can define it as some other banking rather than proper banking. Maybe non-word can be, we can find a way to cover the non-word
right,
and use para-banking. That's a
right,
possibility. I was
right.
told in the Philippines, they use the word para-banking for the captive finance companies or large finance companies.
Okay, okay, fine. I think that's another interesting point. Uh, Now, the recent pandemic, and we've seen what COVID has done across the board to all the sectors across. Now, do you think that and like any other businesses, even NBFC businesses have suffered, we all know, and there have been certain setbacks. So do you think has it impacted to the extent that in our effort to shun away all this negativity may also get affected in the long run? Or do you think it's going to be a temporary phenomenon and perhaps we are almost getting out of it?
I definitely feel is a temporary phenomena, and I should really appreciate the government and the RBI playing a very important role in strengthening the NBFCs and banking, both in giving moratorium at the right time, restructuring of accounts at the right
Right,
time, making the funds available through TLTRO, and making other source of funding line available from CDB, etc. See, the kind of funding arrangement that has been done in the last 1.5 to 2 years to support NBFC to keep functioning the normal activity, that was very important, because the NBFCs, they lend to such people where they don't have reach to bank. So
right,
if NBFCs are not there, especially for SME and individuals or vehicle buyers, if the NBFCs are not there, the business at the in unorganized sector get totally stopped, because the credit is most important, and our ability to help them and then collect money, because everyone need time to bounce back. When you are locked down for 2 or 3 months, and the business to recoup, recover, and bounce back, it takes time. So
right,
one is funding arrangement, and second, right time giving right what call a facility like moratorium or restructuring. Everything has helped in both for customers and NBFCs to come back. I don't call it as a V-shaped recovery because we already recovered from last year, September to March, very fast. Then again, we had a correction for April, May, and to some extent in June. Again, July onwards, we are seeing recovery. Some call it as a W, I'm not sure. But definitely the bounce back has been sharp and people have been responding really good. The customers have really bounced back. They're working hard. And I'm able to see most of the individual businessmen bouncing back much faster than even the small corporates. Large corporates have been doing well, but individuals have come back much sharper, much faster.
I think that's a very, very interesting and very positive thing coming. And let's hope that things continue. And I'm sure, I think let's not get too bogged down by what shape of recovery it is going to be there, as long as there is recovery happening. So thank you, I think, so that brings us to the end of this first part of the N. Now we move to the B, which is the business model. So if I was to ask you in a very short and crisp manner, what do you think is the uniqueness of the business model of an NBFC, any typical NBFC? What is so unique about it?
Uniqueness is the niche. Every NBFC we mentioned, we have a niche presence in the particular lending business model. Whether you are into vehicle financing, whether you're into gold financing, whether you are into LAP. So everyone builds specialization. Very few are there who do not really get into one particular monoline. They get into multiple products. But even when they go into multiple products, they try to build a depth, at least geographically or in particular asset class. So there is at least one depth with them, and that helps. So in India, the communities, the societies are so different from place to place. Business models are different, asset classes are different. There you need to get along with customers and be a partner with them and build business. So financing, for us, we believe in partnership. It is a partnership with the businessman to succeed and make his business success, whether it's individual or whether it's so most of the NBFCs in India have this kind of specialization built. It is not superficial, it is not spread thin, it is reasonably, and also one thing is very, all NBFCs, they keep their margins well. See, margins are very important for any business, especially the financial services, to succeed. A good margin will help you to absorb the shock. There will be a shock, and the shock need to be absorbed. So a good margin and good understanding of the business and good investment, margin investment from the customer, LTV, what we call. These are all important. So most of the NBFCs, I feel, they have done this part well.
So you're saying that NBFCs being the specialists in their own games and on their own fields is what makes them unique, right? And I think that's very well said. Now, I think that brings me to the most interesting aspect, because I think it is impossible almost to talk about any business model if not mention about your company, Shriram, because the way I see and the way we've seen generally, that one very important, unique concept and business model which was pioneered and introduced by Shriram was the whole concept of this used vehicle, or the second-hand vehicle financing. So much so that today we see that this model has spread and become the bread and butter model of a large number of small NBFCs. I think this is a very, very classic, and I know, having had the great fortune of at times personally even interacting with the doyen, none other than I'm talking about Mr. Tyagarajan. So rather than me saying it, we would like to hear from you about this whole, how did it all start? How this idea of getting into this use segment come in?
See, basically, the way we started the business 40 years back, Mr. Tyagarajan was an insurance man, and the way he was selling insurance to everyone, and he found that truckers are most reliable in as far as lending is concerned. He started his own small lending, and he was in New India, and they had a Jai Bharat credit, and there he was referring the customers to Jai Bharat credit. So he knew the customer and the customer base, and he realized that individual operator are trustworthy because he has asset, he has to make a livelihood to support his family, and because his earning is good, he is able to support family plus repay the loan. And asset being very important, he doesn't want the asset to be taken away from the financier. That made him believe and feel that used vehicle individual operator is more important. It's not actually used vehicle. Individual operator is a very trustworthy customer. So only thing is to lend to each individual customer and keep a track, then you need more number of people. See, you need an organization, you need people, you need more number of branches. That makes this business difficult to scale. So this is not a highly scalable business because every vehicle need to be inspected, then transaction to be completed, you have to lend. That's how it started. So we wanted to be lending to transport industry because that is a safe asset, never depreciated very fast, and earning was steady. And as long as economic activities moving, the wheel of the economy, that is truck, will keep earning. That was the basic principle on which we started. Today, we would like to be known as financial to the transport industry rather than just used vehicle financial, because we have over the 40 years have really grown and gone into various part of the transportation industry. So we would like to be financing every aspect of transportation, and that's where our goal is.
Right. No, I think, and also I would like you to share something because, as you said, starting from almost a scratch, and today reaching what I think today your book size is what, about 1.5 lakh crore, so if I'm correct.
1,20,000 crores.
1,20,000 crores. So growing to that size, and still, while correct, you have diversified into the entire transport sector, but still this used segment continues to be a great, significant portion. So there has to be something, which has really not only been able to sustain, but even grow this book. And as you rightly said, you've evolved and come out with a lot of associated product lines and business lines. So if you could also share some things about that. For example, I know something work being done on the auction front or refurbishing, etc. So I think those are some very interesting stories we would like to hear from you.
Yeah, so we started on the building a platform, a physical platform where exchange of vehicle can be done. So there were not many open platform for a customer to go and inspect multiple vehicle and choose one, the best, and check the documents of the vehicle. There are not much opportunity. So we wanted to build a platform to safeguard our own used vehicle transactions, because we felt that when a customer is able to choose from multiple choice, his choice will be better, and also the price will be better for the seller. That's how we started the physical platform on Shriram Auto Mall. Then, of course, we started with so many other things, because once customer buys a vehicle, what he needs to repair the vehicle in time, and he also needs to change the tire in time. He also needs to change the battery or pay the tax on time. He also needs fuel on go. We felt that all these needs, see, either you call it as a working capital needs or whether you call it as the strengthening of asset, because they all help in strengthening the value of the asset, changing the tire in right time, repairing the vehicle at right time. All those things helps customers. So we found that customers often borrow from the market to upkeep his vehicle, to change the tires, and that we felt that without our knowledge, customer borrowing from the market at high cost is not really appreciated. We wanted him to get more reliable source of financing, and thereby we started so many things. Even today, if he has a warehouse, if there's a larger customer, he has a warehouse, or if he has a transport office, he has a shop, or whether he has a petrol pump, whether he has a garage, if he has all these multiple activities on transportation, within the transportation ecosystem, we would like to fund him. So we would like to broad base on every requirement. Tomorrow, I feel the cold storage are going to be very important, and large warehouses are going to be important when the hub and spoke model gets established properly. So we feel that there is a lot, and maybe if there is a more electric vehicle going forward, chargers, charging stations. So we want to see that we are in every aspect of transportation industry to make it really a smooth operation for the customer. So we would like to focus on what customer needs, and we would like to fulfill that need rather than trying to get into a business which we feel profitable but may not be profitable. So we would like to go with customers' requirement rather than we trying to build a particular product or service for ourselves. And of course, we have insurance companies. We have both general insurance and life insurance within Shriram Group, and we are able to give. And in fact, we have brought down the average insurance claim. We can proudly say that average insurance claim used to take 180 days, because we used to give business to the other earlier public sector insurance companies, and we have brought it down to today around 35 days. So 180 days to 35 days, a claim getting serviced is something, a dramatic improvement. That's what we have done for the customers.
I think that's interesting, and I was trying to recollect, and I think in our first episode when we were talking to Mr. TTS from Sundaram, I see two very important commonalities here. Both of you have talked customer as the focus, and I think it's a classic example of how two companies, based on their focus on the customer needs, have developed such fantastic business models, and on their own, individually, both these companies today have grown and sustained over the years. I think that's very interesting. Umesh, now that's one side of the story. As we look today and as we look ahead, I think we see technology creeping in every part of our lives, daily lives, and of course, COVID has given a far more impetus to technology. Now, on one hand, we have pardon me for saying this, the orthodox lenders, where we do asset-backed lending, vehicle-based lending. And today we have the new age lenders, which are purely digital lenders. Over the mobile apps, you simply download an app. There are small ticket size lending happening, which may be unsecured lending for, it could be for small businesses, it could be for your personal needs. So, and we've also seen some concerns coming out of that. Now, how do you see that going ahead? Where can we draw a kind of a balancing act between this digital-based lending and the orthodox lending, which we've been witnessing over the years?
See, what I see, digital is an enabling tool to give better product and better service to the customer. So every company, every bank will adopt a digital mode or digital way of doing business to improve their service quality and multiple product and multiple service. And that everyone has to go. Everyone has to be playing that card or playing it well. But getting the customer through analytics, searching the customers, sending them email, attracting him and lending, that is something which I feel hard to understand, especially in the Indian context, because see, the asymmetry of data is so wide in India. So it is very difficult to make good of any data available. So there is no sufficient data that makes to understand the customer business model. So if at all we are just based on analytic tool, if you're offering some lending, then it is bound to either fail or not scalable, because I have seen many of them are not able to scale, not hardly able to reach around 50 crores, 100 crores, then suddenly getting stuck with some bad debt or some NPA increasing. So this phenomena I'm able to see because the asymmetry in the data, that's very, very important. So I feel personally, all good NBFCs, large NBFCs, and they all will adopt a digital tool. There is no digital divide per se. So I cannot say today that I don't use digital, because any customer for me who pays his EMI or even a part EMI through a digital mode is a digital customer. So today, most of my offering is available on the digital. Today, my customer can fill fuel on go, just on mobile.
Right.
What he needs is mobile and mobile number. If it is registered, there's a pre-approved credit, and anywhere in India, whether it's HPCL, BPCL, IOC, he can go and fill the. That means he can change a tire, he can buy insurance. So everything can be done digitally. He need not visit office, he need not sign any documents.
Right.
So to that extent, the so-called orthodox company also have, every orthodox company, what you say, have today a digital option as an additional service or tool, or making it convenient. Now imagine a situation, 10 years back, when I was going in a Innova vehicle, and I was not knowing that he is my customer. And when we talking, I realized he is my customer. I just told him, what is your wish? He said, I have no time to visit branch and make my payment. This happened around 12 years back.
Right.
Why? He said, it's either I reach home late night,
right,
or sometimes I have a break on Sunday, and I have no way, even when I have cash, sometimes I carry cash in the dashboard, and I'm not able to make the payment. And I told him, you have option of calling my branch and ask him to send one of the executives there to collect the money. He said, I'm not in a particular point of place at more than for half an hour. I'll be moving. How can I ask him to come and collect the money? Then I realized that how to digitize it and how to make it, it's a improvement, it is a productivity improvement tool for both the customer and me. So it's a convenience.
Yeah, so I think that's correct. That let's not create and say that there's going to be a divide. Digital is there in everybody's lives, as they say. There is some amount of digital in everybody. So yes,
anyone carries mobile phone is a digital
today. Right. So let's not try to create a divide, but say yes, digital or technology is going to be an enabling tool, and that is what it is already doing. So correct. Thank you. Okay, so I think now we've talked about the business model, that is the B. Now we move to the third part, the F, or the failures, and what do they teach us? So while we all know, and just like any other business model and any other sectors, we've had failures in the NBFC sector. Do you think, is there anything specific or unique to the failures that we have witnessed in the NBFC sector, which maybe makes them unique or different? And we see a lot of negativity sometimes being spread by, even, I'm pardon me saying so, by the media, to the extent that people start questioning that what role NBFC is playing, and do you think NBFCs should be further tighten the regulation? So anything unique in these failures, or you think they're just like any other business sectors?
Raman, my understanding, if I go internationally, I feel there is a prejudice against lending or companies, whether it is a NBFC or bank, both. It is not just against NBFC. Even banks or bank failure, when I say prejudice, either somebody would have lost money, or the borrower would have charged more interest. So there is always a society is not very, no, very much positive towards banking or any kind of lender, NBFC. So this remains in any society or any country. It is not typical to India. And if there are NBFCs, some NBFCs have failed, and there are some banks also have failed.
Right.
Now, when you say NBFCs recently, they are not typical NBFCs. No, it is not asset lenders that has failed. It is people refer to Island FS. Island FS was totally different. They were only funding themselves for the various projects. They did not lend anywhere outside. So I feel taking a parallel to Island FS is something not correct. So this prejudice against lending organization will remain across the world. So I don't think it is typical to India.
I think that's because, as you rightly said, it's ultimately it's the hard cash or money when we talk about in any financial entity failure. And that is why perhaps this prejudice creeps in, probably, right?
Yes.
Right. I think good. Now, and you know what happens is, as a natural reaction, we often see not only media, and we see some of the learned people, even economists, even and policymakers, often say that moment there are any failures. I'm not only talking about NBFCs, even as you said in other sectors also. The immediate reaction is that the regulation is lax. Let's further tighten the regulation. So, what are your views on that?
Let's say good regulations are a must for giving a fair play on the competition. So regulations are required. Like any sport, there is a rules, because to provide the excellence, to get excellence in a particular activity, you provide a rule, and there is a competition. Right. And the tightening of a rule for a failure is something is not really a fair way of looking at things. Now, you take, for example, take a hockey. Now, what happened is, in hockey, they went on relaxing. They wanted to popularize the hockey. So they went on relaxing the rule. As and when they relaxed the rule, hockey started becoming a popular because the game became very fast. There were more number of goals being scored, and they also made it attractive. So today, when we won the bronze medal, many Indians were participated and enthusiastically appreciated the game and would have watched the game. Right. And they would not have watched the game otherwise. So making a fair play, making a rule in such a way that there is a fair competition and everyone participates honorably and you do not break the rule is important. But right. Tightening will make it unattractive for more players to come in. Ultimately, the fund that has to come to, because the banks are not likely to reach to unbanked or underbanked community. Only NBFC can reach. So tightening will make less money flow into the business, into the NBFC industry. And ultimately, country will suffer. Because in a country like India, where most of the people are still underbanked or unbanked, we need more number of NBFC actively playing the role, and more money need to come. There could be some failure. That should not deter, and that we should not be tightening the rule. We should make it attractive so that more money comes in and business flourishes.
Right, right. Good. So, and I think you mentioned about ILFS, and then we also had another failure in this space when we had the DHFL case also happening. And these are two classic recent examples of failures in the non-bank space. What do you think are the 2 or 3 key learnings from these two failures, ILFS and DHFL?
See, basically what I feel is, as long as you understand your own strength and do business, depth in the business, when you have enough knowledge, then chances of failures are less or remote. But when you go into unknown territory, when you try to grow very fast, then there are some risks. And that risk is something in, when I say asset side. In the liability side, I feel the mismatch was quite evident because many of the companies, when they start getting a low cost, low tenor funding, for example, you get commercial paper for 3 months at lower rate, and you keep on borrowing it and think that it's a permanent source, and you lend to long tenor, then there is a mismatch. Because of continuous flow, it looks as if it is a perennial and continuous. But suddenly imagine the CP stops for some reason, maybe economic condition or maybe related to the industry. Then suddenly what happens is, it is not that cost that matters there. It is non-availability that matters.
Right.
Suddenly you have to shift to long-term borrowing.
Right.
Then there is not enough sources. So then there is a mismatch. So a proper mix of the liability, reasonably, fairly long enough to match your tenor of lending, that helps the company. Otherwise, this mismatch can have some accident. See, it's an unexpected accident, and suddenly there will be a chance of failure.
So as you say that perhaps two things, if I may be correct, that there are no shortcuts in life. I mean, let's not say that if you sprint, you will necessarily reach it faster and sooner. And second is, of course, that we may think and be laud for short-term gains, but ultimately they can lead to long-term pains also, as we've seen in these two cases.
Yeah.
Now, that brings me to another very interesting aspect, and which is the resolution of failed entities, right? Now, we know that in India currently we do have, if I may call, some kind of a vacuum when it comes to resolution of financial entities, because we saw, unfortunately, FRDI bill which was brought had to be withdrawn. Now, DHFL was a classic case where for the first time, we saw RBI and Ministry of Finance changing, bringing in rules under the Insolvency Bankruptcy Code for resolution of NBFCs. And we saw DHFL going that route. And finally, today we have seen resolution happening. And I think if we are to believe, we are almost on the verge of the resolution being implemented now. The resolution plan, everything has been approved. So do you think that the resolution process adopted in case of DHFL is perhaps the right approach for resolution of NBFCs going ahead?
See, any resolution is good enough, and faster resolution is good enough. I think if the lenders come together and make a transition and change the management the way today RBI is doing it quicker, I think that is good enough to keep going, because ultimately you have to keep going. You can't stop and make it unattractive. So again, if you look at the sports today, in the sports you give advantage moment you possess the ball, even if there is a fault, and keep going on. So that's important. You cannot stop business at any point of time. So a quick resolution will help, because lenders also understand out of 100 lending, 1 or 2 can go wrong. So immediately they can come together and find a way to find out what best they can recover and keep going and support the company, or convert some part of the loan into equity and to find a new management to run. And that helps. And I think the current resolution was a little delayed, but still good enough. There is a continuation. There's no, it's not stuck. We're happy, but I would have been happy if there is much faster. Yeah.
Because I think you're right. At least whatever has happened, still it has brought back, restored some kind of a confidence, and done good to the damage which it did when the failure happened. So I think that was a welcome thing. Thank you. So I think now we move to the final part, which is the C, that is the collaboration. Now, a lot of talk has been there, even from RBI and even from the policymakers, about increasing collaboration between banks and NBFCs going ahead. What do you think about this, and what are your views on this increased collaboration between banks and NBFCs?
No, this is very important, because banks also has a limitation in lending to certain social requirements of financing to underbanked, and they know it's underbanked, but their credit policies do not permit them to lend. It's not in India. Across, I have seen. I have met one of the Korean leading bank, and they said we have a credit card company. I asked why credit card company. No, it is actually lending. We are doing through credit card because we can't do it in bank. They felt that, okay, there of course bank itself is having a subsidiary of credit card, but the NBFCs are exactly playing the role, because these bank credit norms are strict, and it is required to be strict because they have large public deposit, and because of that they cannot be nimble-footed, they can't be fast, they can't be lending to the small entities or underbanked, and they may not be even able to understand certain requirement of certain businesses, especially individual entrepreneurs, because they may not have that kind of accounting standards, or they may not keep the information the way bank need. And therefore, it is very important that bank and NBFC, they work as a complementary. The complementary role is very important, and I feel for Indian population, the number of bank what we have is very small. So you imagine in US, after failure of so many banks, still they have more than 10,000 banks functioning there, and 1/5 of Indian population. So that means there is a scope for more number of banks, but India, we cannot afford to have so many number of banks. So NBFC are playing the role of credit delivery. So that's very important. And one or two methods or the arrangements which RBI has brought in, they are good with positive change, but still there may not be scalable. So we need to build a scalable, make banks fund flow into a right NBFC comfortably. It should not be restricted, and banks also have to, I feel banks also has to be a little more proactive when they lend to NBFCs. There could be one or two failures when they lend to NBFC, just the way when they lend to big corporate, there could be one or two failures.
Yeah,
they cannot be highlighting too much on NBFC failure when other entities or corporate fail. There is no talk at all. So that cannot be. So there is a fair game, and we feel that a complementary role, better understanding, exchange of information, and it is very important between bank and NBFC.
The another angle of collaborative model is the collaboration we are seeing within the NBFC space. Now here, once again, I would like to draw example of your company, Shriram Transport Finance. You, I think, were also, if I can say, if not the first, maybe one of the first companies or NBFCs to collaborate with a large number of small NBFCs. So please share your thoughts and how did this idea come up? And if you can share one or two key features of the kind of collaboration that you have developed with the other players in the industry.
Yeah, say very important here is that most of the small NBFCs or unregistered finance entities or even the partnership entities, we thought we should rope in for lending, because small ticket lending and some remote area lending was difficult for large NBFC like us to reach. So we felt that having a a collaborative approach with other smaller entities, NBFCs, would help us and those companies. And many of these small NBFCs or lending companies were dependent on some wholesale funding required from either bank or some other larger NBFCs. And we filled in that vacuum. We started around 15 years back. We tried to focus on the vehicle finance NBFCs or vehicle finance lending institution rather than trying to lend to anyone. Because there are 100 different variety of companies when it comes to unorganized or small lenders in India, and they all have niche. But we wanted to focus on our vehicle financing entities, and we have around 500 such the small companies and NBFCs whom we lend, and we are continuing to lend. The business came down a little bit in between because a certain arrangements which we wanted to do with them did not scale up, because we wanted to have back-to-back arrangement with bank, with the lending, and that became, because information not being fully available, that becomes a little challenging. So we did not really grow the business big way, but still we lend around anywhere between 60 crores to 100 crores a month. It can be scalable. We can reach up to 1,000 crores per month to these NBFCs. The only thing is certain arrangement with the local team we need to develop. We are now trying to develop. We are trying to develop the software and the digital information, which is seamless up to the customer. We want to build. In between, we also had some challenges with tax on taxation, etc. So we wanted to really understand the entire the understanding of taxation in this, and that with the GST coming, there's more clarity now, so we can scale it up. So I feel there is a huge scope and opportunity for us to lend to small lenders, because small lenders are nimble-footed, they know the customer, and they have better recovery ability. And the only thing is, we need to keep their business profitable. If we don't keep the small entities business profitable, then they will not have enough cushion to survive and run the business. So we also have learning over the last 15 years. We have learning, but we are definitely we definitely want to scale the business and make it large. And we really truly appreciate the role played by smaller entities in reaching out to needies.
Right. Excellent. So now let's look this collaboration and this which you talked about, your collaboration with smaller players from their angle. We've seen, often that for small NBFCs, I think it's almost become a perpetual challenge in terms of their ability to raise funds at competitive cost. This has become an issue which we've seen right from, even me now spent 30 years in the sector, we've seen this issue. It was there way back in 90s. It is still continues in spite of whatever has been done. So do you think that this mindset change of, rather than running after trying to raise funds and do everything on your books, to become a collaborative player with a larger player could be a better way for them also to grow and survive?
Definitely, yes, Ramana. Only thing is, there is a proper sharing is required, because what everyone feels that I have to get the money at cheapest and I have to lend at highest and I need a much bigger margin is everybody's interest, everybody's expectation. But sometimes there is a limit to which you can. So I feel if more of them share the information much more transparently, and if you are together, we can bring the cost down, because we can raise more resources and we can bring the cost down. I think it helps both customers and the financing entities, and little bit professionalism need to be built. And some of them, I should say that they depend on some brokers and intermediaries to lend and collect. That is the practice where a lender goes out of touch with customer.
Right.
This is where I've seen some of the small entities failing, because when we give money to them, lend to them, they in turn lend through another intermediary rather than lend to customer directly. And that is something which need to be avoided, and proper data or information being available to us will help us to really scale the business and do much bigger volume.
Right. Good. There's another new age kind of collaboration happening as we see a lot of fintechs creeping up, and as I'm sorry for using that word. A lot of fintechs coming up, and some of them are doing a fantastic job, phenomenal job. We all know, and we've seen a lot of collaboration happening between the fintech players and NBFCs and banks. So, what is your experience in that space?
See, my experience with the fintech has been limited, even though we have collaborated with one or two to understand their platform and find out whether their analytics tool can be appreciated in our system. We have done, but my experience so far is limited. But I believe there is a huge scope and opportunity for us to do a proper scaling, not scaling up, proper business. Ultimately, we need to be useful to the customer and society.
Right.
Whether it is a fintech or whether it is otherwise. If you are not useful to the society, and if you are not giving benefit to the community around us, then nobody will survive. So any existence of any company for that matter, any technology for matter, to provide better service and better facility. So that is the ultimate goal. I feel fintech has to be seen as a tool of improving service and improving the quality, rather than as a gadget or something, a kind of armory in your pocket. I don't think that is going to helpful if you keep it as a what to call trophy. It is not going to be helpful.
I think that should be encouraging news for the fintechs, because I think tomorrow they may, after seeing this, some of them may be rushing to you to look for more collaborative. But
Definitely,
I think that's
yes.
interesting, and I think that is going to be the way forward. So that brings me to one, I think the final and a question which is today often asked from all the leading financiers and NBFCs specifically. So do you think, where do you see Shriram Transport Finance, say 3 or 5 years down the line? Do you see yourself converting into a bank, or continuing the play the way you are and making having increased collaborations with the banks and other fellow NBFCs, or converting to a bank? Where do you see yourself?
I'm very clear that we are not really seeing or looking at becoming a bank, because see, once you become a bank, then you get alienated with what you are already doing. You can't be doing the same lending the same way. You can't be maybe lending to same type of customer. Now, whatever we have built a business model over the period get diluted over the period. That's one. And the second thing is the cost of operation of a bank is much higher.
Right.
And margins are lower. So it is very difficult to really give a good return to the shareholder in the initial period of a bank. Maybe over the period, definitely you can definitely give. So I would rather prefer to have a separate bank within the group rather than convert ourselves into a bank. So that bank can grow at its own speed and NBFC can keep doing what it has been doing. Then probably over the period we can choose which is a better vehicle and think of doing some collaborative stuff, but immediately we don't really see. But I would definitely prefer collaborating more with the bank and also collaborate with my fellow NBFCs, smaller entities or others, unorganized lending, including unorganized lending entities, because they have that expertise. And that I would prefer as at least for next 3 to 5 years. Then there are always unknown things which we cannot explain,
Yes.
and that can happen.
Right. So thank you. I think thank you, Mesh. It was great plan and indeed a pleasure talking to you and listening to your thoughts. If I was to sum up quickly on the first pillar of negating the negativity, you brought in the very interesting concept that the whole business model of NBFCs, the way they function, is a very typical Indian ethos-driven model, and perhaps it would be wrong to draw any parallels from the Western or the developed cultures, and therefore trying to compare the two and bring in negativity is I think, what you said. And another very interesting aspect you brought is this whole definition of shadow. Shadow should not be looked at being shady, but shadow could be looked at as trying to fill in a gap which your key player is maybe leaving. So I think that's a very interesting point. On the second pillar of the business model, what you said is that the uniqueness of NBFCs lies in their being specialists in developing a niche for themselves, whether it's a niche product or a niche geographical area. And the focus ultimate has been on customer, and that really drives the whole ecosystem. As far as Shriram is concerned, you said the business model, and especially that concept of used vehicle lending and the way it has sustained and grown has been typically keeping in mind the entire ecosystem of transportation, and that's where you've now diversified. On the third pillar, which we talked about, the failures aspect, I think you rightly said that whatever failures we've seen is not nothing totally out of the blue or totally different. It's like failures in any other sector. Yes, there are learnings, and the learnings are that there cannot be any shortcuts in life. So we could not be, sprinting and hoping to win every race. Sometimes slow and steady does win a race. And also keeping an eye on, the asset liability mismatch, which is a very, very critical element. Finally, on the C, that is the collaboration. I think very rightly, as you said, that both increasing collaboration on both the fronts, both between banks and NBFCs, and also increased collaboration with your small fellow NBFCs or private entities. And also the third kind of collaboration is maybe with the fintech players trying to bring in more efficiency and faster TAT, as we often call in our system. So I think wonderfully put, and I think this is really going to do a world of good, not only to the NBFC sector, but I think to all the stakeholders, including the potential customers or the borrowers, and I'm sure even the policymakers and the regulators. So thank you once again. It was such a pleasure, and it's always a pleasure to interact with you, talk to you, and learn from you. I'm sure we at CIU will look forward to more such interactions and keep engaging with you in future also. Thank you once again for this.
Thank you. Nice talking to you, Rama.
Nice. Thank you.